Hey everyone, Eric Dutram here with the latest edition of the Dutram Report, the podcast on ETFs and more. Today we have with us Sylvia Jablonski, a managing director at Direction Investments. In today's podcast, we talk about the world of leveraged and inverse ETFs, what segments have been on the move since the election, and what investors need to know about the construction of leveraged ETFs. So make sure to stay tuned for that right after this. All right, Sylvia, thanks for joining us. I think the leveraged ETF world is one of the most misunderstood topics in the fund industry, so great to have you on to shed some light on this topic.
Thanks so much for having me.
First, let's talk about the construction of these leveraged inverse funds. So how is the exposure achieved?
Sure. So Direction essentially achieves the exposure in the funds and delineates the composition of the funds by investing all or a portion of the net assets in derivatives. So typically swaps or futures. In the case of Direction, it's specifically swaps. These derivatives are basically agreements that provide the ability to gain exposure to the respective indices and sectors without the need for a full dollar-to-dollar investment. So the bull funds will generate between 10 and 100% of their exposure from equities and the remainder of the exposure from swap. And the bear funds are essentially 300% swap.
So how do you find the partners for these swaps? Is it with a giant investment bank, or do you guys have certain relationships with smaller companies out there?
Yeah, sure. It tends to be the giant investment banks, right? What we do is we survey the banking community in the banking space, and we work with a lot of the Delta One and equity finance desks on the street. So we have 7 different counterparties that we're working with right now. And essentially what we do is look at, monitor their risk, their CDS, their balance sheet, the ease of trading with them, some of the operational and compliance issues, and basically we work with who we think are the top providers for our swap exposure.
Yeah, it's interesting you bring up the CDS stuff. I was just going to ask, what about the counterparty risk? Do you guys divide up the exposure among a variety of banks, or is it you just try and find the ones that have the best credit ratings, I guess?
Sure. So what we do is we divide up the balances. To answer your question sort of quickly, we have the 7 different counterparties, and each one may have a different balance or a different fund or fund pair that they're more comfortable trading or sort of better at trading. So what we do is, again, we just constantly monitor the day-to-day trading with those counterparties and their balance sheet, financing spreads, the ease and efficiency of the trading with those counterparties. And, really the risk, a lot of people think that the entire notional value is the risk or total exposure that Direction has to the counterparties. It's not the case. The way that these ETFs work and the way that the swaps work is that with each swap agreement, we have a tri-party or collateral account, so a margin account, and that sits at a third-party location, which in this case would be the Bank of New York. So what we're actually posting, or our risk to the counterparty, is essentially the overnight mark-to-market change of the margin. So let's say we post 10, 20, 30%, whatever it might be for a particular swap exposure, and something happens to that bank on that particular day. The real risk would just be the overnight mark-to-market difference in the actual margin and not the total notional value of the swap. And that being said, if something happened today, we have 7 different counterparties. Let's say Bank A couldn't take a trade today. Well, we still have banks B, C, D, E, F, and G with whom we can execute the trade. So it's all about just managing the total balances and who to sort of trade with. And again, some of the compliance and regulatory issues, just being on top of that. We have a person dedicated here at Direction to essentially monitoring the counterparty risk full-time for our firm.
Sure, it's good to know. And are there any differences in how exposure is achieved when you're talking about, say, a 2X fund versus a 3X, or is it all still with the swap mechanism?
It's all still with the swap mechanism. I know that other providers may employ other derivatives or products, such as futures, for example. At Direction, for the most part, our ETFs are essentially just swap and cash positions. We find that it's easy for our market makers and for the trading community to value the funds and price them intraday when they know exactly what is in the product. It's incredibly transparent. You have IOPV files, which are essentially file components that are sent out to the trading and investment community each evening, and you sort of always know what you're holding. And what we like about the swaps, and only the swaps, is just that it's easy to value the funds, which makes them easier to trade and to hedge.
Okay. And let's switch gears a bit and talk about some of the specifics for the leveraged inverse market. All of Direction's funds have exposure which resets on a daily basis. I know this is kind of a hang-up for a lot of investors, so maybe you can talk about why this is such an important feature of the leveraged and inverse universe.
Sure. So I think one of the most important things to understand about levered and inverse ETFs is that they are meant to track the daily performance of an underlying index. And I think that now that we've been around for a long time and there have been other levered and inverse ETF products and firms out there, people are starting to understand how this works. But if you have a view that within the next 10 or 20 days, the S&P 500 will be up 10%, it doesn't necessarily mean that the 3X direction ETF will be up 30%. It might be up 40%. It might be up 20%. It might be down. What's key with our ETFs and levered and inverse ETFs that rebalance daily is the trend and the daily rebalance of the products themselves. So I'll give you an easy example, which I think kind of helps people see how the products work. If you were to buy, let's say, SPXL, which is a 3 times levered S&P 500 bull fund, if you're a client and you buy $100 of that product, that means that you have $300 of exposure to the underlying index, the S&P 500. So let's say on day one you buy that position and that index moves up 5%. So very simple. You have $100. It's a 3 beta fund. It moved 5%. You make 15% or $15 on day one. So at the end of the day, in your trading account, you see $115, minus fees and expenses, commissions, things like that. We'll just keep it simple to the performance. You have $115, and the exposure is $315. Now, when people say the rebalance mechanism, so this is essentially how it works. We started the day with you had 100. We went and got $300 million of exposure through equity derivatives, as we discussed before, and now the market closed. You have 115, and we need to come out with a 3 beta fund. So we essentially have 315 of exposure, which means we need to buy an additional $30 of exposure, right? 115 multiplied by 3 is 345. So what that just means is that on day two, you, the investor, that's going on behind the scenes, you, the investor, have $115 in your account, and your exposure is $345. So if the index S&P 500 moves upward 5% again, you're making 15% again, but now it's on $115. So on day one, the trending market for 2 days, up 5%, 2 days in a row, you made $15. On day two, you made 17 1/4. So, in this case, trend is your friend. It's sort of the best situation for leveraged inverse ETFs when you're on the right side of the trade and the compounding works in your favor. Now, here's how it works against you. Let's take that same example, but on day two, instead of a second day of a 5% move upward, let's say that S&P moves downward 5%. So it's that same concept. It's 115 multiplied by 15%. You're losing 17 1/4 there. So your gain of 15 on day one is wiped out, and now you're down to 25. So a lot of people, that sort of resonates with people, right? Because if you buy Apple today at 110 and it goes up to 115, and then tomorrow it falls back to 110, well, you're flat, right? But with the levered and inverse ETF, the compounding and additional exposure essentially causes you to lose some of your gains. So what's important to note is that they're really designed to seek daily investment results of 3 times, 2 times the bull or inverse performance of the benchmark that they track, and daily market fluctuations cause net asset levels to rise and fall, which basically can cause net asset levels or portfolio adjustments to be needed essentially to make sure that you have or are set at the correct multiple.
Sure. So basically investors should just take it one day at a time with these products.
One day at a time, actively manage, always keep an eye on it. That's the best way to use the product.
Yeah, and what it sounds like to me is the leverage effect can be greater or less than the stated figure over a long time period. And that's something, it's really going to be dependent on the trend. Is that fair to say?
It's fair to say, and again, just two sort of anecdotal things. If you look from 2009 to last summer, and you were long a 3 times levered S&P 500 3X bull fund, you would have been up well over 700, 800% if you held it for that period of time. We would never suggest you do that. We would never sell the product that way or educate the public to think of the product that way. But it's important to note that you had a low, volatile, trending market for 7, now 8 years, and in that case, you see the benefit of using compounding and leverage. But to give you another story, there are days where our gold miner ETFs, which are quite volatile and quite popular, might be down 15-20% in one day. So, the key is monitoring the products, but they're great and powerful tools when used appropriately.
And, I also wanted to ask about another key aspect of this process, the index selection. I noticed a lot of equal weight benchmarks are used for some of the funds, and I wanted to ask why that was the case and, why the equal weight as opposed to the market cap. In particular, we got Lab U and Lab D, which are 3X and negative 3X versions for biotech, and then Gush and Drip, the oil exploration 3X and negative 3X, and great tickers, by the way. But I wanted to know what you thought of as some of the pros and cons of this equal weight approach as opposed to the market cap weighted side.
Yeah, sure. So in the examples that you gave, actually, it wasn't so much a choice between equal weight and market cap weight. What we did is we were looking to create ETFs that gave clients or traders exposure to the S&P oil and gas exploration, companies, and the underlying ETF there, XOP, was the most liquid and sort of popular ETF in the space that traders seemed to like and our clients seemed to like. So that was the rationale behind selecting that particular index. It wasn't so much because of the theory that over time, it's been said that equal weight indices tend to outperform market cap weighted indices. So, that's one of the reasons why people tend to use equal weight. But in our case, it was just more of in the biotech XBI and in the oil and gas, which is XOP. Those are the two underlying 1-beta ETFs. That's really what people were trading. So when we launched the levered product on those underlying tickers, we wanted to look at the most popular ETFs that had options, liquidity, and ability for market makers to create efficient markets. So that's why we chose those. In those two spots.
Good to know. I always thought it was because, those would be a little more volatile than their market cap weighted counterparts, but good to know that it's a little more involved than that process. So I did want to ask, following the election, we've obviously seen a big surge in broad markets across the board. I wanted to ask if you've seen a surge in interest in any particular leveraged or inverse ETFs as a result of this sort of massive uptick in the market. I bet the gold miners, and particularly the junior gold miner, like the Bear products, have been pretty popular, but I'm guessing the small cap ones as well. But is there anything maybe a little bit below the radar you guys have noticed has been really impacted?
Yeah, what's been really interesting post-election is that the rise of the USD has been unprecedented. Really, USD hit over 101, which is a level that was last seen about 14 years ago. So market continues to expect a big shift in fiscal policy, and it seems that there has been a market reaction to suggest some optimism for economic growth. So what we've seen is sort of in line with that, right? So we expect that there will be some sort of rate hike, right? And we tend to see rate hikes with a strong USD, and this is often positive for financials. So, regional banks, which can charge higher interest. So we've seen some flow into our DPST, which is a regional banks bull fund. We've seen a lot of people shorting emerging markets or USD-denominated debt countries like Mexico, Brazil, or just emerging markets in general. I heard a comment the other day on the news, I can't remember who said, I think it was on CNBC, somebody said Trump officially burst the bond bubble, right? So I think, we've definitely seen some flow into TMV, which is an inverse 20-year Treasury Plus. It's a 3X fund with a negative 51 duration. So basically, as interest rates rise, bond prices will fall. This ETF will do quite well because it's tracking 3 times the inverse of 20-year plus duration bonds. So a lot of interest there. Small cap and health for sure. I think small cap relative to large cap has been outstanding post-election. The small cap stocks have risen about 10% versus 2% or 3% for large cap. And I think a lot of that is just the belief that deregulation from the upcoming administration will open up M&A activity, less cost for operating. Same sort of thing for biotech. I think there's some relief rally on the greater scrutiny of the drug pricing regime going away. We've seen NASDAQ experience 15 days of consecutive positive returns after the election. So, yeah, I would say a lot of long small cap, long biotech, healthcare, short emerging markets, short treasuries. Those have been the popular trades. And of course, most recently, some of the news around the OPEC deal to cut production, we've seen some flow into the 2 ETFs you mentioned before, Gush and Drip, as well as just energy, bull and bear, and Russia bull and bear.
Yeah, I wanted to ask real quick about the energy play because I believe I heard XLE, the Spider product, had one of its, most the highest volume days it had following the OPEC announcement. So have you seen a similar move in volume in some of your, triple leverage products. And it sounds like the oil exploration was sort of the way that a lot of investors played this move. But do you see anything different on your side from the leverage perspective?
So it's funny that you mentioned XLE. We have ETFs that essentially track that same index multiplied by 3. So there's 3X bull and bear funds, ERX and ERY. So they're essentially, 3 times levered daily XLE. And basically, the news on OPEC to cut daily production by 1.2 million barrels. We saw a huge, sharp move in the energy sector on that particular day. So I think, I think there's some general positive results on energy, bodes well for energy exporting countries. So I think people will start looking at our Russia ETF as well. Russia is the largest oil producer outside of the OPEC bloc, half of their revenues from oil and gas, and then just in general gush and drip the oil and gas exploratory companies. So we did see a lot of movement into the bull funds around that news, but this sector is just tricky in general, right? It's just, I would say it's volatile. So we see flows in both sides of the trade. It's hard to say whether it's all bull or all bear or all, hedging or speculation, but with volatility, I think volatility presents short-term opportunities, and we definitely see traders going into gush drip, ERX, ERY, RUSL, RUSX, as well as just GasL and GasX, which are natural gas-related companies. So, they have a couple of options to play that sector.
Yeah. And, just sort of as last question here, I did want to ask your perspective on what you think is next for the leveraged inverse ETF world. Do you think we'll ever see let's say a 0.5 leverage fund or even a 4X fund? It seems like everyone kind of stopped at the 3X mark. Just sort of wondering what you think is next on the horizon for the market.
Yeah, sure. I think, what's on the horizon is really what the masses want, what the clients are looking for. We at Direction are surveying the market and trying to find holes or what might be missing or what might be a beneficial product for clients to use within their portfolios, which would employ leverage. So, we've tried the lightly levered ETFs, for example, the 1.25 beta funds, LLSP, LLSC, and what they do is essentially it's the daily S&P 500 1.25X and then the daily small cap 1.25X. And, products like these are really meant for the traders who are less active. So, we definitely talk to a lot of active, sophisticated RIAs, hedge funds, asset managers that are constantly monitoring their accounts. And 3X is great for them. They understand the risks. They understand how the products work. But we also deal with a lot of clients that are just have longer-term investment horizons. They're looking for some leverage that they have access to some of the tools that hedge funds have, without having the prime brokerage or margin accounts or trading options within an ETF product. But 3X is a little too much. So for those clients, we launched 1.25 to give them gained or increased exposure to market sectors and industries and lower compounding risk than ETFs with higher leverage points. So I think that while these products still have to be monitored, there's far less sort of decay, and it gives the client a little bit of leverage and efficient deployment of capital, but a little more peace of mind knowing that they can hold the product for a period of time and not worry so much about the long-term decay. So I think we'll look to products like that for clients that are more buy and hold oriented, and I would say active buy and hold oriented, but not 3X guys. So I think we're trying to plug a hole where we'd like to deliver leverage to those who have an appetite for leverage, but with less risk.
Okay, and I did just want to throw in one more thing. It seems like some of the hotter sectors are also getting some leverage inverse attention. I know the cybersecurity space, you guys have a couple products there. HAKK is the bull. So it seems like that could be a possible area for expansion in the leverage inverse world. Is that fair to say as well? It's
definitely fair to say. And off of that and the hot cybersecurity topic in the U.S., we also came up with CWEB, for example. That was our next sort of follow-up in that space, which is a daily CSI China Internet Bull 2X ETF. So, we're definitely looking at sectors that are topical and that, traders are looking at that simply don't exist. So something like a CWEB, for example, just gives traders access to China A-shares technology sector There's a huge shift in consumer purchases to online retailers in China, and they've had over 40% growth within the first half of the year. The GDP, they've had GDP growth, and retail sales grew about 10% year over year in 2016. So these are just great products that will allow investors to express opinions and access, some of those fundamentals in foreign markets and in internet-related technology markets.
Great. Okay, Sylvia, thanks for joining us. I think everyone who listened definitely should feel a bit more comfortable at using leveraged inverse ETFs in the future. And I think this was a great discussion of what's really been the focus following the election as well. So thanks for coming on.
Thank you so much. Thanks for having us.
All right, everyone. That was Sylvia Jablonski, Managing Director at Direction Investments. If you want to learn more about how leveraged ETFs work, go on over to directioninvestments.com and check out their guide for additional information. Well, hope you enjoyed this edition of the Dutram Report, and make sure to tune in for more interviews and discussions on the world of exchange-traded funds in the future. And for my thoughts on the ETF world, make sure to go on over to Zacks.com and check out the ETF Investor Service, which includes my top picks and commentary on the markets. Until next time, for Zacks.com, I'm Eric Dutram.